Hello there, this is Dario Kerkez, Certified Financial Planner with IHT Wealth Management. Today we'll be talking about something I very seldom find when I speak with family and we do financial planning. And usually it's a cornerstone for the family's finances, one of the cornerstones. And that is the family's balance sheet. So what is a family's balance sheet? Well, family balance sheet pretty much and very simply outlines all your assets and your liabilities, and it can be actually segregated by the ownership. Who owns it? Is the husband or is the wife? Is it joint ownership? What's the total? Also, we can itemize the liabilities per name as well, or joint liabilities, and that way we can actually have all assets and all liabilities on one single page, and that really is a balance sheet. So when you subtract all your liabilities off your assets, you're pretty much going to get the net worth. Now the net worth can be positive if the assets are larger than the liabilities. Also, it can be negative for some people that are just taking tremendous amounts of debt, mortgage debt, credit card debt, and are not accumulating assets. They might actually even have a negative net worth. But let's just focus on a simple case of a family. This is just going to be the fictitious case of the Kevin and Christine. They are in pre-retirement phase, and they do have some assets and do have some liabilities. So we need to name the individually owned assets, like the individual checking accounts, savings accounts, joint checking savings accounts, retirement assets like 401ks or an IRAs. Then a separately owned annuities. Annuities, we'll just call them as a after-tax or non-qualified annuities. They may have a taxable brokerage accounts. Then we can have Roth IRAs or Roth 401ks. Then we can have the life insurance and cash value inside the life insurance. We can have a personal property. In that terms, we can put a personal properties, jewelries, cars, etc. Then we can have real estate properly, like individual house or vacation property. There can be a rental property unit, etc., etc. We can have the other types of properties like a business interest, etc. The reason for this exercise is pretty simple, is that on one single sheet we can see all the assets, and then we're going to name all the liabilities. So let's say if we do own a house, we might actually have a mortgage on the house, which is going to be listed as a liability mortgage that actually to the bank we are paying the principal and interest. We're not including taxes or any association fees, etc., because they're due regardless, even if you own the property outright. Then we have a credit card debt. We can have the personal lines of credits, etc. Now, when all that is listed and netted, we're going to have the net worth statement. That's going to be looking something like this, and it's going to be like a pie chart that you can actually see enlarged in a couple of minutes. It's going to be probably attached later in this video. So in the pie chart, we're going to see the composition of assets. What's the cash and cash equivalents? What's going to be the taxable investments as an after-tax accounts? After-tax accounts are taxed on a capital gains, if there's any, or we're going to have a 1099 for any qualified dividends. That's why it's important to segregate them. Then we're going to have a qualified retirement assets. What it means that when we take those assets out, there will be, let's say this one in orange, they're going to be coming in as a 1099 ordinary income. Then we can have something in yellow like a Roth IRA. Roth IRA in retirement is going to be coming out tax-free, so there'll be no income taxes there. Then we can have a partially owned, individually owned annuities. And non-qualified annuities, only the gains are taxed as ordinary income, but then the principal is coming out tax-free. Then we can have a life insurance cash value that you can borrow against the policy, similarly to a Roth on a tax advantageous basis. Then we can have real estate. Real estate in this case is charted in brown as the real estate we own. And lastly, we can have some personal property. Now, it's important we can classify all the assets we own minus we own and then we can project how these assets and how the balance sheet is going to be looking like in some distant future, whether that is in maybe in 5 years or 10 years, or for some younger couple, 30 or 20 or 30 years from now. So as the liabilities are being paid off, let's say the mortgage is paid off, credit card is paid off, personal credit is paid off, etc., and then the value of assets is increasing, and maybe we are putting in more money as contributions to the 401k, the cash value life insurance, the taxable after-tax accounts, brokerage accounts, etc., then the balance sheet might be looking a little bit different, and the composition of these assets might be looking a little bit different. Why is that important? It's important because we can in this way classify where the income will be coming from, and then we can work with our tax advisors and see what accounts are better to trigger to produce income, or maybe partially. So let's say we can take 10% from Roth, 20% from qualified retirement, 50% for Social Security. That way we can optimize income for tax purposes, and also it can help the planning for our estate planning in case we're to pass together with our spouse, or if we're single, so we can identify assets that are subject to probate, and what assets we've got to specify in a will, or maybe transfer in a trust, so we don't go through the probate process. I hope this helps. In case you do need help creating a balance sheet for yourself or for your family, feel free to give us send us an email, or click in the link below, and we'll be happy to produce one balance sheet for you. Clearly, you have to identify all the assets and produce some statements for that matter. Thank you for watching. Have a great day.